Talk to us about the evolution of private credit, what it is now compared to what it was 2 decades ago.
So we've seen a seismic shift in the last 20, 30 years in terms of how companies are financed, how assets are financed. It used to be in the domain of the banks, has shifted in a major way towards institutions like Ares. Started in the U.S. with bank consolidation, bank got large, they forgot about their middle-sized clients. In Europe, the case is a little bit different. It's really the GFC that shrank the banking sector. And then as a result of that, we saw a lot of regulation be imposed on the banks. So in European context, the industry is probably more like 10 years old, and we've seen institutions continue to gain market share. And all the while, we've seen institutional investors, we've seen retail and wealth investors looking for that durable yield. So they've been funding this expansion for managers like Ares.
What have you seen in recent weeks and months in terms of activity in the sector? How has the volatility in public markets, the uncertainty coming out of the White House, impacted private credit?
So we entered this in a pretty good stage. Our firm had record deployment last year through March of this year. And actually, we have record dry powder as well, about $140 billion. And when we think about deployment today, we think about it in a couple ways. The first is, it's not solely tied to M&A, although M&A within the middle market continues to be fairly vibrant. But we look at companies that need financing. That can be refinancing of existing facilities. It can help them consolidate industries. So actually, deployment has held up relatively well. We've also seen it broaden to our asset-backed group, to our secondaries team. Whenever you hear about pensions in the U.S., whether it's universities, whether it's state or local, announce they may think about selling, that gets our secondaries team excited. So actually, deployment has held up relatively well considering the dislocation. And then lastly, I would say, when banks get more nervous, that's when we can step in and look at larger companies when capital markets are closed. We've announced a multi-billion loan in the past couple weeks in the U.S. in this regard, and we're on that trajectory in Europe as well.
Have you taken market share from the banks during this period of volatility?
I think so. Again, we take a pretty measured view. The capital markets will always be there. They have a purpose. But I think the great thing now is that companies understand that they have financing options. This really came to fore in 2022 and 23 when the capital markets were closed for about 12 months. So definitely we're seeing more large companies approach groups like Ares for financing.
It's interesting to see the banks coming back into this space because, as you said, we've really seen the private sector boom as a result of regulation on the banks in the financial crisis or on the back of the financial crisis. But now banks are increasingly doing more lending to private credit funds like yourselves. And this is raising some alarm bells from regulators around the world that banks could be ultimately exposed if we do see a downturn and some of this credit turn sour. What's your reaction to the concern from regulators?
So certainly our relationships with banks have evolved in a different way. As you said, they now fund many of our businesses. I think when you examine this, you have to look at the bank's ultimate risk position. Number one, it's incredibly diversified in high-quality businesses. And secondly, when you look at where they're actually lending into these structures, they might look at a senior loan or a portfolio of senior loans and then lend to the least risky part of that on a portfolio basis. So I think when the rating agencies consider their ultimate risk position, it benchmarks incredibly well versus other AA, AAA assets that they might have on their balance sheets, but certainly worth looking at.
I think the concern is around the opacity in the industry and the fact that we don't have as much scrutiny on a lot of these companies and a lot of the credit that you're extending. So there is concern from regulators that they don't actually have the clarity that they would have for public investments.
So we welcome these conversations with regulators. We're actually quite open. If you look at one of our investor reports, we literally go line by line, loan by loan, detailing what our risk exposures are, how they're performing. So actually, we think it's quite open. Even in some of our public vehicles, our wealth vehicles, the amount of transparency we give on these loans on a line-by-line basis is very, very robust.
Let me come back to this conference. There's thousands of GPs, LPs here, record numbers in attendance. And this comes at a time when there's already speculation that we could have seen peak PE already. What's your take? Have we seen peak PE?
So this is currently very topical at the conference. I would say Ares is active in the PE space. We're long-term believers in the space. We do think that there are companies that are better owned in the private domain for longer-term capital planning, optimizing capital structures, industry consolidation. But make no mistake, we are aware of the challenges that PE is facing. Whether that's on the exit side, there are 30,000 PE companies that need to be realized. There's also $1 trillion of dry powder that needs to be put to work. Their investors want DPI, they want money back. But again, we've seen these phases before. As a firm, we're long-term believers in private equity.
Do you think that the stock market is now a structurally less friendly place for IPOs, and feeding into the argument that maybe PE is facing structural headwinds that aren't going to get better even if the cycle improves?
Yeah, I'd address that in two ways. The first is certainly the number of public companies has been on the decline for many, many years. I think that speaks to some of the advantages that we discussed around being a private company. Secondly, I think when you consider exit opportunities for private equity historically, actually only a small percentage of those went to the IPO market. Many of those would have been sold to strategic buyers. Again, these are companies that are valuable and can fit other larger businesses. And lastly, they're often sold to other private equity firms who can then take these businesses onto the next phase of their growth trajectory.
Let me come on to the opportunities you see in private credit here. We're in Berlin right now, and there seems to be a lot of buzz around Europe at the moment, in public markets for sure, but also in private credit. Where do you see the growth opportunities in Europe specifically?
We've been active in Europe for about 20 years. We've now built about $100 billion of assets in the European markets. We've seen things grow dramatically. I think at this particular time, we've seen the ECB be very accommodative on rates. Generally, lower rates are good for economic activity. We've seen the Draghi report released at the end of last year, proposing really for one of the first times ways that Europe can be more competitive on an international scale, talking about deregulation for the first time, and some of that's beginning to be implemented now. So I think from a European perspective, especially now when there's a little bit more caution around the U.S., we're seeing lots of opportunities in Europe. And further, private credit is less penetrated in a European context than it is in the U.S., and we see that penetration continuing. So overall, we're quite excited about the opportunities in Europe.
Are you going to be a consolidator in Europe?
So we've already done that in some ways. Again, at Ares, we built many businesses organically. European private credit, when I joined the firm, was $1 billion of assets. Now it's about $80 billion. That's organic. However, inorganically, the firm just closed our single largest acquisition to date of GCP International. One of the things that brought the firm was significant logistics business here in Europe. We now have $17 billion in the ground. That's consolidation. We have 17 million square foot of logistics facilities. So again, I'd say we're growing in both ways as a firm.